As mentioned, it's a little shinier, a little more polished, thanks to Kara,
Looks
my
good.
wonderful fiance. Hold on one moment. All right, we're going to cover content in the same format that we do every month. I've I'm taking out the KWCP versus the market just so we can have a little bit more time to focus on what is actually happening out there for us, like the primary underlying driving factors, because those are the things that affect all of our businesses anyway. So that's just kind of another way of talking about what we are already talking about. And I just wanted to be able to focus more time on the data itself. One thing I wanted to add, so we talk about the underlying economy and mortgage rates, then we go into real estate specific data, talking about the DMV market for the most recently reported month, then we take a 30,000 foot view, go up a little higher, look at trends over months for the past couple of years and quarters, then we zoom back in, look at Washington, D.C. specific, and close it out with the final week. One thing I added this week, and it's been something I've been wanting to do for a while, is I just wanted to make it clear, maybe for people who each month maybe be joining for the first time or don't quite have a clear picture of why I cover the economy and what it means. So I added this little flow chart. There's also a slide on the next page. So when I send out the deck, this describes it in a little bit more detail. But I just wanted to have an easy way to illustrate why I'm even talking about the economy and why it's important. Now, this is a little oversimplified, but it's accurate, and it is more than accurate enough to help explain the importance of all of this. And so basically, when I'm talking about the things I run through, I talk about employment, I talk about inflation, I talk about retail sales, industrial production, manufacturing output. And the reason I talk about all of those things is that those are the major components of what we refer to as the economy, and the economy is measured in GDP. Also, why I talk about that. Now, related to that, we have the Federal Reserve, which is always monitoring what is happening. And I have here, you can see kind of in the 3/4 of the way down of this next slide, the Federal Reserve has a mandate, and their mandate that guides all of their actions and decisions is to try to maintain full employment and stable pricing. Stable pricing means they would like to see inflation right around 2%. So they want full inflation or full inflation, full employment and inflation right around 2%. And when that's not happening, they'll take action in order to achieve that. And for our purposes, the primary actions they take are adjustment of the federal funds rate, quantitative tightening, quantitative easing. People also refer to that as QE and QT. So quantitative easing, they did that during the pandemic. And that was when they started buying massive amounts. I mean, billions and billions and tens of billions of dollars every month of mortgage-backed securities and 10-year treasuries. So what that did is just flooded money into the market. And just you can kind of think of this Federal Reserve policy. Basically, it's like they either put money in or they take money out. The Fed funds rate does the same thing. The Fed funds rate is what banks charge to each other to lend money overnight. It's kind of like the cheapest rate of getting money. So if the cheapest rate of getting money is going up, then every other cost of money is going up. Same thing, and then QE is just them actually throwing cash in or taking cash out. So just think of the Federal Reserve in general is they either make it easier to get money or harder to get money. And this relates to where the economy is. So these two things then influence what is happening in the bond market. Mortgage-backed securities are part of that. 10-year treasuries aren't exactly a bond, they're a note, but similar enough for our purposes. So that all goes into affecting the bond market, the MBS market, and then that affects mortgage rates. Most mortgages are packaged into mortgage-backed securities and they're resold to investors. And it's kind of commonsensical that when when people can offer a lower rate of return on these mortgage-backed securities and sell them, then lenders can offer a lower mortgage rate and still repackage where everybody kind of gets their piece of the pie. So that's why we talk about all of this stuff in the beginning, because it doesn't directly, but it very importantly, there's a strong causal chain between this stuff and mortgage rates, and it is what affects it, why it goes up, why it goes down, why it's a little volatile right now, and that is why we talk about it, because right now, at least, there is nothing more important to our businesses, in my opinion, than mortgage rates, because it's affecting everything. It's the reason why for this year and last year, we'll have had the lowest number of transactions in the DMV since 2008. Nationally, we're going to have the lowest number of transactions since like 94 or 95. The only reason for that is mortgage rates. Once they decline, we will see once they decline in a meaningful way, we'll see a fairly dramatic increase in transactions. So that's why I spend so much time on all of this. Does that make sense? Was that helpful?
Yes.
Yep, it definitely was.
Is this something where it's like, this is obvious, Paul, you don't need to cover this? Or
No, I don't think it's obvious. Like you said it a bazillion times, actually looking at it, I'm like, oh, I kind of get it a little more now. Like, I think you need to tell me about 10 more times, then I'll get it.
All right, well, I'm going to cover this every month for people who haven't been before, but probably do it in a little bit more abbreviated way. But thank you. Glad it's helpful. And like I said, this is kind of what I just said, and just with a little bit more detail, be sending that out in the deck. Okay, isn't this just shiny and nice? Isn't this pretty?
It is pretty.
Yes.
Thank you, Kara. All right, mortgage rates. Where are they at? What's been happening? Anything happen over the last 24 hours with mortgage rates?
Went up a little bit.
Yep. Yeah. Mortgage rates popped up about 20 bips since early yesterday, and
We'll probably see something today as well.
yeah, and that's Todd Petey with Envoy Mortgage. One of our, for anyone who's not Fulcrum or not familiar with Todd, he's an excellent loan officer, and always love to hear his input. So I'd like to hear, and I think kind of the expert analysis right now is nobody knows exactly what's going to happen. Mortgage rates are going to be elevated for a bit. There's going to be a lot of volatility. But two things before we move on from mortgage rates, I'd love to hear a little more just Todd's thoughts of where we're going to be at for the next couple of months. And then I would also like to hear if anyone has had a client lock in the past week. I mean, it's almost like if the data is more than 24 hours old, it's old because there's been a lot of movement in mortgages. But I always like to hear most recent data. So Todd, what do you think? Where are you're thinking we're kind of going to be in this like 675, 725 range for at least the next few months, and probably not going to see any kind of like even much downward movement until like third, fourth quarter of 2025, or what are you thinking?
Yeah, I think that's about right. I think really when we start getting into the low sixes is sometime the end of next year. I think for right now, there's a lot of uncertainty. Inflation still isn't as low as we want it, and it's kind of flatlined, right? So it's not really going down anymore. The economy's doing well, which means there's not much of an incentive for the Fed to really cut rates aggressively. And they came out after they cut rates in their policy announcement yesterday and said that they're only going to cut them 2 or 3 times this upcoming year in 2025. So they went from 6 cuts down to 4 cuts. Now they're saying 2 or 3. So their aggressiveness to really spur the economy keeps decreasing because the economy continues to do well. So when you don't have much incentive, while the housing market is really hurting from it, the rest of the economy is doing really well. So, the Fed's job is also to not crash the economy as part of stimulating it. And, I think they're gonna really hold off. I think we're gonna see rates right around where they are for a while.
I mean, it could be forever. That's where they were before. Like we did like 6
Yeah.
and 7 is like normal. So we just got to get used to it, and we kind of are. So
I think
we're here.
I think a healthy market is in the 5.5 range for interest rates, just given where prices are and wages and things like that for affordability. I think that's really where everybody struggles the most is the affordability issues, both from first-time buyers and move-up buyers, right? Your mortgage payment's gonna go up by 30-40%. That's a huge jump. Nobody's income is going up 30-40%. So a lot of that will be focused on affordability, I think, going forward too.
Mhm. Yeah, and that's there's always so many interesting things I'd like to cover, and we have a limited amount of time. So I think of popping in, like January is a good time to cover some additional stuff because of just like start of the year. But there are it's so much interesting related to that. Well, first I want to comment, we're going to go more into the Federal Reserve and the economy and all of that stuff in just a bit. But yeah, if anybody's like, what happened with the stock market yesterday, is that Chairman Powell freaked out the markets, in the Federal Reserve too. Like it wasn't even they dropped it a quarter point, but that was a much closer call than the prior drops had been. It was far from unanimous. And yeah, I mean they as clearly as they could indicated that they're slowing things down, and we'll talk more about that in a minute. And then when it comes to mortgage rates, like there are a lot of smart people out there who are saying that the US consumer appetite and economy really it depends on lower mortgage rates. So once inflation is under control, the Federal Reserve will have a little bit of try to have a heavier hand in keeping rates in a moderate level, which will cause them to be a little lower than they would be at market equilibrium. Whether that happens or not, like inflation has been such a problem for so long, we're not even close to the point where the Fed can start thinking about other things. So yeah, interesting stuff. Thank you, Todd.
Yeah.
And what about, has anyone had anybody lock within the past week? Todd, who have people you've locked in the past week? Where are they at?
Well, a few days ago we were high sixes. Now we're definitely going to be low sevens. Like I have somebody who just went under contract last night, right? Like the timing, unfortunately, couldn't be worse in terms of between the spike in rates yesterday and then the way the market looks like it's going to open. I think rates will probably be up another eighth or so today. So, we've had essentially 3/8% movement in about 48 hours, a little bit less. So that part's going to be tough for consumers to swallow if they were making offers last week and they don't go under contract till now. But yeah, I mean, we're talking low sevens now. We were high sixes.
What's the highest condo rate you've locked lately?
Ooh, 7.375.
It's not bad. I was thinking
Not
it'd be 7.5
terrible.
maybe, but how about anyone else? Has anyone had a client locked in the past week or on a listing heard what your buyer locked at? I should have asked. I just ratified on a listing. I should have asked what our buyer got, but didn't. All right. Well, moving on. So, yeah, just we're low sevens. Everything jumped by about 30-year jumped by about 20 bips yesterday. Other products in the 10 to 17 range, and there's just like expect volatility. I would not recommend anyone tell their clients one way or another what mortgage rates will be within the next month or two, because if you're right, it's going to be purely accidental. I mean, it's just expect a lot of up and down. And if there is a drop, like if things drop and there's a 6.75, it might be a good time for clients to get rate locks. This is basically since August. You can see we were coming down from the summer high. We had just the fall of beauty and wonder here in September, and then ramped back up. We thought we were getting a little reprieve, but you can see here this jump that we've seen recently. So already covered what people were at, where they locked. Mortgage volume, not even sure why I cover this anymore. I mean, it's so straightforward. Rates drop, mortgage volume increases, rates increase, mortgage volume declines. This data is always at least a week old. So we're going to see next week, whenever data is reported again, I'm sure we're going to see a decline in mortgage volume. So how, it's for those of you who are listening, you might get a little bit of a cheat because Todd touched on this briefly, but what do we know about inflation and jobs? What's been going on?
Inflation's going up, jobs are strong.
Exactly. Thanks, Tommy.
You betcha, Paul Nalabandian. You betcha.
So the monthly increase was 0.3%, seasonally adjusted, and this is it matched market expectations, So the market knew this was coming, but it's still not great news. This is the highest month-over-month increase in the CPI in 18 months. So we had been seeing some positive numbers. We had been getting some, oh, these are the lowest numbers, you know, the all items 12-month index, these are the lowest numbers we've seen in a year, and so on and so forth. And the most recent data, not so friendly. You can see the all items is at 2.7%. That's the highest rate for all items 12 months since July. And going back to this, I keep waiting for shelter costs to come down, and I still expect it to happen, but it's been taking a while. Shelter costs, once again, they've been accounting for between 40 and 60% of these inflation numbers for quite a while. And if anyone's thinking, Paul, what are you talking about? You're crazy. Why do you think shelter costs will come down? We're seeing all these sales prices go up. Well, the reason for that is the way they account for sales price is primarily like lease or lease equivalents. Most leases, the majority of leases are 12-month leases. And so those shelter costs that they're pulling are always 12 months old. And so we've seen some rental rates decline in some of our markets. We've seen those prices come down, but that just hasn't been affected. That hasn't been captured yet in the data because of this 12-month lag. So going into jobs now, we saw there was originally October's jobs numbers were reported at adding 12,000 jobs. That was upwardly revised to 36,000. Still a very, very, very low number. People were kind of taking a peek. The market thought it was because of hurricanes, strikes, all of that. But if we had a weak month, this past reporting month, then that could be signs that there is more genuine softening of the employment market. That didn't happen. November added 227,000 jobs. That's very robust. Unemployment rate increased slightly from 4.1 to 4.2. That's still effectively no unemployment. So job market still very strong. Gains driven, and you hear it's the usual suspects: healthcare, leisure, and hospitality, and government. Government and healthcare almost always near the top of jobs gained. So strong economy. Todd touched on this, and this is also why the Federal Reserve kind of like took a bit of a step back, took their foot off the accelerator. And this is a bit of a broken record. You've been hearing me say this for quite some time now. It's the economy just keeps outperforming expectations. It just keeps outperforming expectations. And so every time we think we're getting some indicators that things are slowing down a little bit, then either those rebound or some of the other indicators are stronger than expected. And that is why, like this, we're going to talk about retail sales and manufacturing output now, but it's like all of this stuff is the reason for what happened with the Federal Reserve yesterday. Don't think I mentioned this at the top, but as always, next month we're going to be going to a live stream, so I'll only be able to communicate via comments and chat and all of that. But for now, people can still talk, so feel free to jump in and interrupt and yell out questions and comments. I think the engagement and interaction is where a lot of the value of this comes from. All right, so when we already talked about this, so not much of a question. When did the Federal Reserve Open Market Committee last meet, and what happened?
Yesterday?
Yesterday and the day before. Excuse I'm trying to limit the sniffling and coughing, getting over a bit of COVID, so it's still here, but I'll try to keep my extraneous noises to a minimum. Yep, Federal Reserve Open Market Committee met yesterday and the day before, and this was one of the meetings throughout the year where they provide basically more information afterwards. And that more information wasn't positive for us. So what happened? They dropped rates a quarter point. That was to be expected, but it was a much closer vote than prior reductions. So there were a lot of people, Federal Reserve governors, who didn't even necessarily want to drop that much. And then in Powell's post-meeting comments, he said that they plan to have fewer rate cuts in 2025. He indicated he believes that they're already close to neutral, and that's the Federal Reserve's goal in the federal funds rate, is they want to be at a neutral rate, like neither kind of heating things up or cooling things down. And he said he thinks they're kind of at that neutral point. If the Federal Reserve is saying the things are at a neutral point, you cannot say more clearly that's going to slow down rate adjustments. And it went from, I think the market expectations for next year were 6 rate decreases. Now people are thinking in the 3 range. And if anybody joined last month when I was talking about the impact of the new administration coming in and all of that, it's like, who knows? I mean, honestly, who knows? It would not shock me if there were no rate decreases next year. I mean, I see a world where that's possible because a lot of new administration policies, if enacted, could lead to higher inflation. And, if that happens already, we saw an uptick. Like I said, just, here we go already without even, additional higher budget deficits and all of these other things, which could stimulate prices. We're already seeing the highest month over month increase in 18 months, and we're seeing the highest all items 12 months since July. So yeah, the next meeting is scheduled for January 28th and 29th. My guess would be they'll just hold steady at that point. 10-year Treasury, no shocker, that jumped yesterday also, as did mortgage rates. That was at 4.519. Let's take a look. While I'm looking this up, Virginia, our economics master, anything you would like to add on that?
I think you nailed it on the head in terms of interest rates. So we were talking about this during the team meeting, right? But when people ask you, what can we expect? I would say we're not expecting anything dramatic to happen with the interest rate, at least in the first 6 months, right? So we do think that the prices are going to continue having small increases in the DMV area. Obviously, this is neighborhood by neighborhood. So when you think about a stable interest rate and prices continue to going up, there is really no reason why people should be waiting, right? I'm going to wait until the spring. It's not going to look any better, right? If anything, there will be more competition. So I think that the holidays are always a season where people are going to be talking about real estate and making plans for the new year. If you can have conversations about accelerating those plans in the first quarter, I think that will be my advice. And I think that will be very smart for, especially on the buyer side.
Mm-hmm. Absolutely. Thank you, Virginia.
Mm-hmm.
Yeah, if for those on this call, if you only have one takeaway from our session this morning, I think it should be, so we've been in this for about 2 years now. I'll talk about in a minute. Transactions and I mentioned this before, for this year are right about the same level as they were last year. And mortgage rates have been elevated for quite some time now. If somebody wants to buy or sell, we're kind of past the point of waiting for things to change, because unless they can wait 2 years, unless they really don't care, now is the time to just do what you need to do and then refinance later. And it's the same thing for our businesses. Like, if you've been in real estate for a year or two and you're doing okay, keep doing the things you're doing, because there's not going to be meaningful change. You're not going to have like 2020, 2021, where your phone's just ringing off the hook with people jumping into the market. And so it's just kind of slow and steady wins the race. Keep up with those activities. Keep following up with your leads, converting those leads, because I'm not expecting any kind of meaningful change for quite some time, other than, like Virginia mentioned, continuing pricing pressure. I mean, that's outside of certain markets in the district itself. For most of the areas we practice real estate, there's going to be price appreciation, and that's going to continue. Nothing's getting cheaper. All right, going to just hit through the remaining major sectors of the economy before we get into real estate specific data. So retail sales, advanced estimate released a couple days ago indicates the retail sales increased by 0.7%. So you might say, hey, it's the holidays, sales are going up. Why? That's not a big deal. Yeah, it's true, but market experts they expected an increase, but this beat expectations. And as I always said, it's like, by the time data comes out, the market's already reacted to it, because there's a lot of people's jobs, livelihoods, savings at stake here. And so people aren't waiting until they get information. They're trying to predict what that information is going to be and taking action before that point. And so when the data is actually released, kind of the more meaningful thing is how it relates to expectations. So this was a nice bump in retail sales, and it also beat expectations. The October figures were also revised upwards. So pretty vibrant, robust market out there for retail sales. And I just want to add before we move on that as happens a lot, motor vehicles are very important in all of this stuff, in retail sales, manufacturing output, industrial production, all of these things. And motor vehicle and parts dealers significantly contributed to that. There was a bump for them, 2.6% in November. So manufacturing output, manufacturing in general has kind of been like meh for quite a while now. In November, industrial production decreased by 0.1%. Following 0.4 of a decline in October. So this is the third straight month of declines, but it wasn't as much of a decline as the market expected. So industrial production was actually a little bit better last month than the market thought it would be. Manufacturing, core manufacturing itself rose by 0.2% in November. This, as I mentioned, you're going to hear motor vehicles again. This was bolstered by a 3.5% increase in motor vehicles in parts. So this, though, was less than what the market thought. The market thought manufacturing would increase by about 0.5%.
And Paul, I don't know if you have this data point, but going back to consumer spending, I think it's interesting to look at a consumer debt, right? Because all that spending is basically resulting in increased debt. So, going back to a real estate conversation, right? We're seeing a lot of buyers saying, I want to buy, I just don't have enough cash reserves, right, for paying my agent's compensation and the closing costs. So there is definitely a big compression in that. And because of inflation, and people are, basically financing their living expenses. So I don't know if you have that data point, but we're definitely seeing that on the street at the level of, buyers feeling very cash strapped.
Mm-hmm. Mm-hmm. Yeah, thank you for mentioning that. That's something I just made a note to myself. I'll probably cover again in January. I'll chime in on that every so often, but I haven't seen the most recent data, but yeah, I know like credit card debt in particular is just, I mean, and when you think about that, like you think about what affects, which is why a lot of these retail spending numbers defy expectations, because it's like people are just packing on more debt. But I mean, just imagine I would say, like HELOCs and credit cards are the things that are most immediately affected by increases in interest rates, because most of them are floating and it's instantaneous. They use a benchmark. It's a benchmark plus whatever. So that benchmark increases, and next cycle, those interest rates are up. And so all of these people carrying these credit card balances, which for a while, it was basically money was free. And now you're seeing credit card balances in the 20s, 30, and it's costing people so much. And so you keep thinking, and this is what's been happening for so long when I said the economy's outperforming expectations, you keep thinking like the other shoe's got to drop at some point, and it just hasn't yet. The same thing with some of the other stuff we've talked about in the past, like all of this office this office real estate that is empty and going in, like, the point where interest rates are going to reset, and expecting these massive defaults, and how is this going to affect the economy? And so far hasn't. So, it's like some point there has to be a reckoning. Let's just hope it's not like, 06, 09 or 99 or 80, whatever. But yeah, at some point the other shoe's gotta drop. So speaking of the other shoe not dropping yet, though. So the second estimate came out between last time we spoke, this time we spoke. Second estimate came out for Q3 2024. Is the same, 2.8 for that also. But the current projections for GDP for Q4 has ramped up. So Federal Reserve Bank of Atlanta has a GDP Now model, is illustrated on the left side. But I always want to point out, their model tends to run hotter than almost any other model. So they're going to kind of be at the top, but it's still instructive and helpful to look at. They were at 2.6 last month when we met. they're now up, as of yesterday, they were up to 3.2, expecting a GDP of 3.2 for Q4 2024. That's a robust economy. I mean, that's 3.2 GDP. Nobody's worrying about anything. That's a really nice number. All right. Now we are going again. Isn't this pretty? This is pretty. We're gonna now know. Oops, sorry. An agent is asking how to join because we're not doing the live stream. Hold on 1 minute. Okay. Some more encouraged audience participation. How's the market doing? What's been going on? Median days on market. Do we think they've got, this is a gimme too. I mean, do we think median days on market have gone up or down since last month?
Up a little bit, right?
Yep. Yeah. It's it kind of as to be expected, a little seasonal. Pricing though, like pricing is like if I had zero idea and somebody just asked me median sales price from November into December, I'd say, yeah, probably dropped a little, but not really the case. So median, this is all for the DMV. We'll talk about DC specifically in just a bit, but median sales price basically even month over month. I think it was $599 last month. It's up 5.3% year over year. This is, as you can see, I'm yelling here in the slide. This is the 18th straight month of monthly year over year increases in the median sales price in the DMV. And you're going to see a bit of a shocker. I always add a caveat when I'm talking about stuff like, except maybe DC, except maybe DC. Well, DC median sales price, I think, went up 10.1%. year over year.
Wow.
For the past month. So it's if you have buyers who are thinking of waiting, I mean, literally, like I don't want you to be a jerk, but if you have buyers who are thinking of waiting, I think the most important question is like, what are you waiting for? To pay more for a home? Because that's all that's happening. Like that's all that's happening. Everybody who has been waiting up to this point, outside of certain pockets of DC, all that is happening is the home they want is going to cost them more money because there hasn't been a meaningful drop in mortgage rates. And when there is a meaningful drop in mortgage rates, you can refi. I mean, refi costs about, $4,000-ish, like which is real money. But when we're talking about the cost of homes here, it's really insignificant compared to just a small uptick in appreciation. Bright MLS came out with their projections for 2025, and they're projecting 4% appreciation for the DMV in 2025. So, I mean, 4% times whatever is going to dwarf, $4,000. So just, yeah, it's like even with a slower market, median sales price keeps popping up. It was also a little more robust just activity wise. So we saw closed sales for November. And so this is, the top says December 2024, which is obviously what we're in now, but all of this data is from November. So closed sales were up 7.5%, and you might think, okay, well, those were closed sales from November, reflecting pendings in October, but pendings for November were up even more, 13.8%. So we're seeing a lot of activity still in this market. There's a lot of business out there. There are a lot of buyers still out there. I just went under contract 2 days ago on a listing. I mean, we're approaching Christmas. We're in the middle of the holidays, but compared to where we have been, we're still at a relatively robust market. As I mentioned, so median days on market did pop up just a little bit, but still 13. That's not much. That's a lot of homes going under contract in less than 2 weeks.
Hey, Paul, can I just ask like what people are feeling? Like I get the stats, but my feeling based on the listings and the activity, the last like 10 days have been significantly more. There's more activity. There's buyers coming out of the woodwork right now that I hadn't seen in a while. Is that just anecdotal? Is anybody else feeling the same thing?
I
Well, all right then. Super helpful.
I've noticed it a little
I haven't
bit.
experienced like I haven't felt like it's been massive, but like my feeling reflects the data that wow, it's like we're still strong. Maybe things like it's even a little bit hotter than things were. And I'm having like buyers reach out and say, hey, early 2025, we want to get rolling.
But I had like crickets October, November. Like October, November were like in my world terrible. Nobody's showing up to do nothing. And then all of a sudden the last like 2 weeks, people are just coming out of the woodwork. Is that
Todd, you
the
were
data?
gonna, I mean,
Data doesn't really show
Todd, you
that.
have a better pulse than a lot of us in that, like, are you just getting all these appointments lately?
It's similar to Tom. Like I've had some people show back up making offers in the last 2 weeks. I haven't had a ton of new apps, like people, just getting started, but people that were kind of hanging around for a little while in October and November
Mm-hmm.
feel like they're trying to look right now. And I don't know if that just has to do with the market's slow, so they're just continuing to look. And now some opportunities are showing up. But it hasn't been a massive flood, but it's definitely the last 2 weeks of activity have been a little stronger, at least for me anyway.
Yeah, and we'll see that in the most recently reported week as well. It's cool. One of the nice things about the market being down for 2 years is it doesn't take much to to get me excited. Uh, all right, these are just the what we just talked about in a little more detail. If you want to take a closer look when you get to the deck. So we're gonna go look a little bit of a county breakdown: closed sales, median sales price, and the median days on market. So closed sales are up pretty much everywhere except DC and Arlington. And they're up big in Fairfax and Loudoun, both 16.7, 16.8%. That's a pretty meaningful jump there. Median sales price up everywhere except for Arlington. And as I mentioned, up big in DC, 10.1%. And there is we'll see in a little bit that's driven by detached fee simple. So it's not necessarily, I mean, anyone trying to sell a condo in DC is like, what? I'm not seeing that. But yeah, so a little bit skewed, not the market overall, but there's still some upward pricing pressure in certain components of the DC market. Everywhere else, kind of around 5. Right around 5, Loudon 3, 4, but kind of in that close to 5 range. So median days on market, again, not a shocker. DC leads everyone in days on market. We're almost at a month for DC. Surprisingly, though, we're getting a little company in the district. We got some others in the vicinity. So big jumps for Alexandria, Arlington, and Frederick. Alexandria is up to 2 weeks. Arlington's up to 19 days, and Frederick is up to 18 days. But I mean, take days on market this time of year with a grain of salt, because there is just they tend to creep up even though the market's relatively robust overall. So taking a look now at pendings, listings, and showings. So new pendings are up big in Fairfax, about 30%. Love to hear if anyone does a lot of business on here in Fairfax, if they've seen that. If just that sounds, those are numbers like that sounds like what you're talking about, Tom, where just all of a sudden like a meaningful kind of boost there. Frederick and Loudoun, same thing there, almost 30% increase in new pendings year over year. Down big in Arlington, though, dropped by about 15%, about even in Prince George's County, up, but not quite as much as Fairfax, Frederick, and Loudoun, but up by about 15% in Montgomery County, 8% in DC and Alexandria. So new
Look at the
listings,
showing volume.
what
The
was that?
showing volume is up. The showing volume is up double digits everywhere. Like I think that's the biggest number. If you look at the showing.
Mm-hmm. Yeah, absolutely. New listings, hit those super quick. Up almost 12% in Alexandria, 2.5% in Fairfax. New listings down everywhere else. And so you look at it's like new listings are down, but showings are up. We're gonna get to active listings in just a sec. But yeah, showings almost even in Arlington, but up 11% in DC, 14% in Prince George's County, up 20 to 30% everywhere else.
And I think
And
that's your indication, right? That January and February is going to be active, right? So
Mhm.
going back to what Tom was saying, normally you see right after kind of like Halloween, things start slowing down and they slow down for November and December. There is a pattern. Like November and December behave very similarly. This year it didn't, right? And we're seeing all this interest and in showings and offers. And then that tells you that we're not going to have kind of like a quiet winter market this year, right?
Mhm.
So I think that those are really good news. When you
Yeah.
see the number of showings going up significantly, that tells you that we're going to have a busy winter.
All very true, but I just want to add the little asterisk, busy compared to what we've been experiencing.
Yes.
Because we're still across the board about
Correct.
30% below 2019 levels.
Yeah.
And so it's like when things have been so slow, sometimes, one person shows up and you're like, hey, wow, this is things are. So it is, yeah, compared to what we've been seeing, we should expect some robust market, but still kind of below what the historical norm would be otherwise. Thank you, Virginia. So active listings down about 12% in Arlington and Loudoun, almost even down 3% in Fairfax, even in Prince George's, pretty much up big. Active listings are up by about 30% in DC and Alexandria. Frederick, Montgomery County up around 10%. So months of supply, no shock here as well. Most supply in the district itself. Supply has gone down just a little bit from prior months in the district, but still 4.65 months of inventory. Everywhere else, no meaningful inventory, like no meaningful inventory anywhere else in the core DMV outside of DC. You're looking at a little under a month to 1.67 months. I mean, that's nothing.
Do you know what that data is without condos?
For DC
Like
inventory?
like condos are crushing DC, right? In lots of ways. Like they're doing poor. Like if you took condos out of the mix, do you know how the numbers change?
Yeah, it's still so like detached homes. If somebody was like, you can only do one type of property in DC, what do you want to list? I'd say detached homes because they're still doing the best, but it's not like there's still a decent amount of inventory. And I have that. I'll show you that in just a minute. Just off the top of my head, I think it's like condo inventory was at 6 months previously. Now I think it's like at 5.6. And then detached inventory might be like at 3.6 and row homes at like 3.8. So it's still, regardless of property type, much more inventory in DC than anywhere else. But yeah, it is condos higher. Home demand, I'm gonna kind of breeze through this. It's just like home demand, it's low, but in this shows like Virginia was just touching on. So the home demand index for a month ago was 71, now it's 68. It's basically the same. We're not really seeing as much of a seasonal decline. It's kind of steady, and we experienced pretty much the same thing last year. So you can see we're running a little bit hotter than last year, but pretty much parallel in trend over at least the past 3 weeks ish month that's been reported. So this is just putting in context, already touched on this before. As of end of November, year to date, we had sold 45,860 units this year. Last year at this time, 45,639, almost the same. We hit 48,950 units last year. We're projected to hit 49,187, essentially an identical year. And this is the lowest number of transactions this year and last year, lowest numbers we hit since 2008. And it's still enough for everyone on this call this morning to have the best year of their real estate careers. So at this point, like if I hear anyone complaining, if I hear any agents complaining right now, I'm kind of just like, just shut up. Excuse the, but it's like, it is what it is. Just like do your job, work hard, keep your business going. And then when things do improve, you're just going to have a bounty. But it's like at this point, 2 years in, you know, it's pretty obvious what we need to do here. And 48,000, I take 10% of that. Give me 4,000 transactions. I take that. I take 1%. Anyways, all right, moving on. So this is just, you can take a look at this later, just kind of showing overall year long where we're at, general trends. Same thing with the quarters. If you needed something else to kind of reinforce the fact that we have a price appreciation, upward pricing pressure, you can see that going back to Q3 2023, every quarter we've had increases in the DMV and average sold price. Sorry, that's a typo up here. Average sold price and median sold price. Same with the monthly. You can see going back to July of 2023, every single month, and this is what I talked about before, we've seen bumps in average sale price and median sale price. All right, now we're just going to zoom in to DC proper, take a quick peek at this. Just expected seasonal kind of decline in DC overall and among all property types. You know, fewer closed sales in November than October. Year over year change. So this is detached homes, and you can see this. It's like related to the median sales price as well. 35% jump in detached sales in the district in November compared to November of 2023. Row homes and condos, though, were both down about 6 to 8%. New listings, actual new listings, kind of expected a little bit of a seasonal decline overall and among all property types, lower than the prior month. Year over year, fee simple is down. So we had a drop year over year, 32% in detached new listings, a drop of 12.7% in row home new listings, but condo listings were up 8.7% over the prior year. We've already talked about if you're listing condos in DC, if you're meeting with clients who want to sell condos in DC, please don't guarantee a quick sale, because it's possible, you know, just perfect stuff can still go under contract quickly, but it's not uncommon to have a wonderful condo priced well just sitting on the market for a bit because there's so much to choose from, much more supply than demand. I mean, condos are the closest thing to a buyer's market that there's been since I've been in real estate in any area in any market near here. Months of supply actual. So this is going to Tom, what you were asking before. So condos are in purple here. Condos aren't quite at 6, which is what they were at last month, but pretty close. Detached, like I said, I think it's around 3.6. Row homes are around 3.8. But still a lot more inventory, even among fee simple and DC than elsewhere. Year over year change, detached inventory was pretty much the same as it was last year in November, but we saw big bumps. Row homes were up by about 35%, condos up 58%. Days on market, pretty much even across property types for the last month. Everything right around 27, 28 there. Year over year change, higher days on market for overall in everything except row homes. Slight little drop in days on market year over year. Median sales price to list price, no shockers here. Expect this to decline as we head into the winter months. And it did so overall and among all property types. Median sales price to original list price year over year change, also down overall and among all property types. So even seasonally adjusted, little softer pricing market, assuming agents are pricing the same way, which isn't necessarily a safe assumption. I mean, I would think agents are being a little more conservative in their list price recommendations now as opposed to last year, which means that these drops are even more meaningful, because if they're already being a little more conservative in their pricing and we're getting a lower percentage of that list price soft pricing. So median sales price actual declines from the prior month for row homes and condos, but an increase from last month in the median sales price for detached. Talked about detached are we're seeing a little bit of a separation from row homes and condos, and then Also, same thing with the median sales price year over year. Median sales price for detached homes was up by 37%, but condos were down 7.3%. And you know, like we said, we're seeing kind of slower condo market. Row homes were up 3.9%. All right, this is the most recently reported week for the DMV. So days on market are high, but you know, kind of what you'd expect this time of year. Just things are, even though we've talked about kind of robust comparatively, still 36 days on market is what you'd expect this time of year. Surprising increase in pendings, though. We're seeing pendings up this past week by almost 15% compared to a year ago, and even up compared to a week ago. So we're heading ever so close to core holiday time in December, and we're still seeing bumps in pendings from earlier in the month. Showings up as well. So showings were up about 10% compared to a year ago, but showings have slowed down a little bit. And that is not surprising to me, because at times like this, it's the more casual buyers tend to take a break. So it's not shocking at all that there are fewer people out there, but those people who are out there are a little more serious. So a decline in showings, but an increase in pendings makes perfect sense. Bump year over year of almost 20% in active listings. Taking a quick peek at North Central Virginia for Dominique, if she's still on here. Pendings were also up by a fair amount in North Central Virginia from last year and last week, up by about 18% compared to a year ago, up by about 7% from last week. Showings up just a little compared to a year ago, 2.5% decline from the prior week, but big jump in new listings. New listings up by about 30%. And we have 3 minutes to spare for Q&A.